you were to watch the news, you'd think someone forgot to wish the stock market a happy new year. 2016 hasn't started well as far as the markets are concerned. If you've seen the headlines, you know that the Dow Jones has fallen, the S&P 500 has fallen, the TSX has fallen, the price of oil has dropped, the Canadian dollar has dropped below 70 cents US, and if you've really paid attention, you know that the Chinese stock market has fallen the hardest. All this can be very unsettling to investors. Many are asking us, does this mean we're in for a bad year? Is a bear market just around the corner? Should I buy? Should I sell? Or should I hold?
We are big believers in starting the year off on the right foot. For that reason, we want you to know why exactly markets are behaving this way. Most of all, we want you to understand what you can do about it. That way, secure both in knowledge and intent, you can get your 2016 off to a good start, regardless of how the markets are doing.
The current market drama is merely a continuation of last year's storylines. In this case, the two culprits are a pair of familiar characters, China and oil. Let's take oil first. Contrary to popular belief, the price of oil is not controlled by a single person or organization. Actually, oil prices are dictated primarily by the law of supply and demand. You probably remember this from your Economics 101 class. When the demand for oil is greater than the supply, the price rises. Conversely, when the supply of oil is greater than the demand for it, prices drop.
For some time now, the supply of oil has been far greater than the demand for it. There are simply so many countries around the world drilling for oil. Think Saudi Arabia, Russia, Nigeria, Canada, and the United States, that the world has a glut of the black stuff. In fact, this surplus is likely to increase in the near future because many of the sanctions long imposed on Iran are being lifted. Iran's own supply of oil is poised to flood the markets very soon.
Meanwhile, the demand for oil is actually decreasing. Many countries that normally buy oil, such as China, are experiencing hardships of their own, meaning they have less money and even less need for fossil fuels. So, too much supply and too little demand makes for falling oil prices.
Unfortunately, when the price of oil falls, it takes everything dependent on oil prices with it. For example, falling oil prices makes life harder for energy companies and companies closely aligned with the energy industry. The result? Falling stock prices, which leads to market volatility as a whole. The decline in demand for oil paints a somewhat worried picture about the growth around the world.
While a decreased reliance on fossil fuels is probably good for the world's environment, it doesn't say good things about the world's economy. It's hard to predict what will happen to oil prices moving forward, but most analysts believe they will continue to remain low. So watch this space, or better yet, keep an eye on what you pay at the pump.
With respect to China, the problem started in June of 2015. At the time, China's stock market was on an incredible hot streak. With the state-owned media urging them on, many people started pouring their money into stocks. The resulting growth was explosive but unsustainable. As the demand for stocks increased, so did the stock prices. And that didn't deter investors, who kept buying as long as the stocks looked like they would keep going up.
Meanwhile, the overall Chinese economy had actually been slowing down, and despite its size, was in fact relatively weak in terms of growth. Debt skyrocketed, and investors awoke to the fact that their nation's economy wasn't an effective prop for their nation's markets. This sudden loss in confidence led to a sharp drop in their stock market, which in turn upset markets here at home.
Because China has been gradually shifting from a manufacturing-based economy to one based more on spending, growth has slowed significantly. To combat this trend, China has allowed the value of its currency to weaken. This makes it easier and cheaper for Chinese companies to export their goods, but it also brings negative consequences. In this case, it hurts the very stock market the government tried so hard to bring under control.
In the vast network that is the global economy, China serves as an extremely large hub. That's why China's problems don't just affect China. They affect everyone who does business with China. When China's manufacturing suffers, the countries that export raw goods suffer as well. Furthermore, when China's currency weakens, it means buying less oil and fewer machines and cars from the countries who rely so much on exporting to China.
All of this causes stress on governments, economies, businesses, and by extension, the markets. So those are some of the reasons for the recent market volatility. But the question remains, what can we do about it? For answers, be sure to check out our videos on tips for what to do in a volatile market.
So that's all for today. Be sure to follow us on our Facebook page for regular updates. Thanks for stopping by, and we'll talk soon.